welcome back. Today we're going to talk about one of the most common myths about dividend investing. Listen to this guy.
But TJ, when the company pays your dividend, the stock price will just drop by the exact same amount. It doesn't matter. Got him. Dividends are dumb.
Alright, so let's talk about it. Because while it's technically true in a very short-term, mechanical, financial theory sense, it totally misses the bigger picture. And it might even work in your favor if you're a smart, long-term investor. Yes, when a company pays a dividend, sometimes the stock price drops by about that same amount, but that's because the company's handing out cash. So the value of the company decreases just a little bit. But here's the thing, the price drops, you get paid, and you have the same amount. So you don't lose money, you just got a cash dividend in your account. Now, if you sell the stock right after the dividend, then yeah, it looks like a wash, but most dividend investors, and especially the kind that subscribe to our channel, aren't flipping stocks for pennies. We're in it for the income, for compounding, and for the long haul. We want to see the price go up, and we want more and more cash distributions. All right, but let's step out of the world of financial theory for a minute, where we assume a lot of things that happen in the real world don't happen, and that the price is only being affected by the dividend and not the future of the company. And let's come to the real world, and we'll use some common sense. So imagine if every time a stock paid a dividend, that the price dropped and it just stayed down. What happens? The stock gets cheaper, but it's still paying the same dividend, so the yield goes up. If you can find me one of these companies, I would love to buy it. And I'll show you why. Let's check out a spreadsheet.
All right, so here is a stock with that hypothetical price is going to drop by the dividend paid. We're starting with a 5% yield. I did $100 and a $5 dividend to make it easy. And this dividend is going to grow by about 7% a year. That gets us to the Chowder rule. If you're not familiar, let me know in the comments. I'll record a video about it. But you can see in year one, we pay $100, we get a $5 dividend, that's a $5 yield. Then the stock price drops to $95, but the dividend grows by that 7%. So we get $5.35 and the price drops again. And if you follow that down, you can see that after 15 years, the stock price is actually negative. And if you look at the yield, you can see it climbs pretty quickly. And our total dividends received, even though our stock price is minus 70 cents, we've received $112 in dividends. So we've actually made a profit, even though our stock is worth negative dollars. But you have to assume that at some point, if this kept happening, that somebody would step in and buy this stock, especially if it kept paying higher and higher dividends. You know, you look 10 years in, you've got a 10-year history of dividend growth, and you're yielding 17%. This is going to get a bid. This is going to get bid back up. So it's pretty obvious that this phenomenon can't go on forever, and it's not that big of a negative. And this is assuming you just buy one share of the stock and let it sit. But let's see what happens if you reinvest your dividends. So here's our stock price, our dividend that we're getting this year, the number of shares we own. This is the dividend we receive, and this is total dividends received, and this is the value of the equity. So if we look at the stock price and the number of shares we own, that is our equity value. So let me explain real fast the difference between this column and this column. So this is going to be the dividend per share. This is going to be what we receive that year based on the number of shares we own. And this is the total dividends we've received for the entire time we've owned the stock. And again, you can see that this makes it even more powerful. If we keep reinvesting, our equity value remains exactly the same. But in this year, we're going to receive $11.26 per share. So we're going to get $106 total in year 14 here. So again, if you can find this stock that really does this in real life, please let me know. I would love to own a whole lot of it.
So this is how income builds over time. And if you're not selling, these short-term dips don't hurt you. They may actually help you grow your income stream faster if you buy more shares when the price goes down. And here's the reality. Most strong dividend-paying companies, like the ones we buy at Compounding Dividends, don't just fall forever. They might drop on the ex-dividend date, but then they recover, and as earnings grow and sentiment returns, the business keeps growing and the stock price keeps going up. So this drop on the dividend day criticism, it's kind of like complaining that you lost $5 while you're holding a $5 bill in your hand because it's not in your wallet anymore. You didn't lose anything. You just got paid by the business you own, which is kind of the point of a business and why you want to own it. So dividend investing, we look at total return. So that's price plus income, not just staring at a stock chart and panicking over little price movements. So the next time you hear this criticism that the stock price drops when the dividend gets paid, you'll know that it's just noise and that the person that's making this argument hasn't really thought through all of the mechanics or is just existing in a world of theory. If you found this helpful, hit the subscribe button for more investing content like this, and let me know in the comments what dividend stock are you holding for the long term, even if it drops a little bit whenever they pay you your dividend.